Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers. So please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. There's a link down in the description box of this video. Click on that Webull link. Open up that new Webull account today. Go get that free stock. Go get that free money. I'm going to send you a Webull tutorial video. All you got to do is DM me on Instagram at RichardFane28. Let me know you've opened that Webull account. Let me know you funded that Webull account. And I'm going to send you that free Webull tutorial video to walk you through how to use the Webull app so that you can start building wealth immediately. Breaking news, guys. The Federal Reserve did not increase short-term interest rates today. They paused. The Fed chair, in his 2:30 p.m. Eastern Time comments to the American people today, and in his Q&A, gave us some forward-thinking guidance. And that's what we're going to talk about. The Fed chair talked about why they did not increase short-term interest rates today. He also talked about the decline in the housing market. He also talked about why a recession is canceled. So we're going to cover those three topics in today's video. Now, again, guys, I'm no expert. I'm just a guy on YouTube. I'm just giving you my interpretation of what the Fed chair said in his comments. My recommendation is for you to get out online yourself and do your own fact finding. Come up with your own conclusion. But I'm going to give you my conclusion. I'm going to give you my opinion. So let's start with why they did not increase the short-term interest rates today. The reason they didn't increase is they have felt like over the last 20 months, they have rapidly increased short-term interest rates, and it's working. The whole purpose of increasing the interest rates was to slow down inflation, bring inflation down. And that's what they've done. June of 2022, inflation was 9%. That's headline inflation. In today's environment, it's about 3.7% headline inflation. So the rate hikes have been working. Now they want to see if we don't increase rates, what will the economy do? What will inflation do? And that's why they pumped the brakes and said, okay, let's not raise interest rates. Let's give the economy a chance and let's see what it does over the next month. Because they'll be meeting again in December. And the Fed chair did not rule out today that there will not be more rate hikes. He specifically said there could be, but it depends on the data. So that's what they're going to be waiting on and reviewing. And then when they meet in the middle of December, if they believe the current short-term interest rate of 5.5% is sufficient enough, they won't bump. If they do not believe it's sufficient enough, then they always have the ability to keep increasing rates, guys. But at this point, they feel pretty good that inflation has come down sufficient enough for them to pause. We're not out of the woods yet because we need inflation at 2%. That's the target rate, 2% for inflation. Right now, Core inflation is above 4%. Headline inflation is just a hair under 4% at 3.7, I believe. Remember what I said in today's earlier video, that the CPI inflation report for October will be coming out in about a week and a half. So not next week, but the week after next, we'll get that CPI inflation report for October. And that's what the Fed Chair Jerome Powell was alluding to, is more data. Let's see what our economy will do if we pause rate hikes. And let's see what the data will tell us about inflation. So that report will be coming. Also, he tied in the hot labor market. Now, according to him, he says, even though over the last several months, I would say the last 3 months, we've been averaging around 266,000 new jobs being added to the economy, he believes that is a reduction from where we started out earlier in the year. And I've alluded to that in some of my more recent videos when I said at the beginning of 2022, we were doing well above a couple 100,000, almost 300,000 in new jobs being added. We were doing more than that. So it has come down. But he also said at a 266,000 new jobs added to the economy, that's still aggressive. That's still way too much in order to get inflation down to that 2%. So he believes further cooling off of the labor market needs to happen. Now, according to him, he believes with the rate hikes they've already done, more pain is coming, right? It's just that lag effect. Now, this is me paraphrasing, and this is my interpretation, guys. Some of you guys may feel differently, but I'm giving you my interpretation, right? My interpretation was he believes the labor market is still too hot to get inflation down to 2% and stay there. Now, according to him, they believe with the rate hikes they've already done, there's a delay factor there, a delay factor. It's going to kick in, and that's going to further slow down the labor market. We'll see in the coming months, right? We will see. But he also threw out, if that doesn't happen, they always have the ability to go back to increasing short-term interest rates again to make sure it happens. So right now, they feel confident that inflation is coming down at the pace they needed to come down, and it will stay. And now the goal is what? Price stability. The goal is to have the right amount of jobs being added so that our labor market doesn't go to zero, right? We don't want unemployment to go from 3.8 where it's at today to 5.8. They don't want that, because that would be terrible. We would be in a real full-blown recession at that point. So they don't want to do that, but they do need to slow it down a little bit more. And he believes that lag effect will catch up with the labor market. These interest rates they've been hiking over the last 20 months, that will catch up to the labor market at some point. And according to him, they see some evidence that's already happening with companies, right? Companies are going to start feeling more pressure. Why are they going to feel pressure? Because interest rates are high. And he alluded that in his comments. He said, hey, listen, when consumers have to borrow money at 8% to buy a home, that's not sustainable. People can't afford it. They can't buy. When companies got to borrow money above the Fed funds rate of 5.50, let's just say, hey, you go to your local bank, I'm some big old gigantic company, I go to my banker or my team of bankers, and I want to borrow $50 million, I want to borrow $100 million, and my interest rate is 6.5%, 7.5%, that's huge. Companies can't make any money at 6.5%, 7%. They can't. So he's thinking with the already elevated rates that companies will start feeling more and more of that effect when that limits their ability to borrow money. And I've always told you guys, most companies, they borrow money cheaply and to invest in their growth. And right now he's saying it's too expensive for them to do that. So he believes the labor market will cool off even more in the coming months. as this lag effect of increased interest rates catch up to the business borrowing world. It's already caught up to the consumer borrowing world, right? You go to your local bank right now, your prime rate is 8.5%. That's a monster. When you're talking about any significant amount of money, you throw an 8.5% interest rate on it, that's escalating. Because remember, prime rate is variable. Anytime they move that Fed funds rate, the prime rate's gonna move because the prime rate is always 3% higher than the Fed funds rate, right? That's why you don't see a lot of people running around here trying to get lines of credit on their house anymore. Why? Because right now they're prime plus whatever the bank wants to charge you. It might be prime plus 2, prime plus 3. So I'm 8.5% at prime plus 3% spread for the bank on top of that. That's 11.5% interest rate to borrow money, guys. That's super expensive. People can't do that. And the Fed knows that. That's the reason he also said, we're gonna leave interest rates higher for longer. I mentioned that in this morning's video as well. I said that's one of the key phrases you guys wanna listen for if you listen to him, and he said it several times. Rates are gonna be higher for longer. What he's saying there is, until they get inflation under 2%, guys, that's the target rate. Because he believes, and the Fed believes, price stability, right? And a healthy job market, not an over healthy job market, but a healthy job market and price stability are their two main mandates. And right now, the labor market is not in balance. It's not in balance right now. At least that's what they believe. And certainly price stability is not in balance because there are people out here in our country who can't afford the basic things they need to live. Why? Because prices are too high. Even with prices at 4%, guys, 4% increase in prices, which is what core inflation was, right? 4% year over year. That's still more than people are getting from a wage increase. If I'm getting a 3% wage increase, but my goods and services that I buy with those wages increased by 4%, doesn't take a rocket scientist to figure out I'm in the hole. My wages are not keeping up with the price of my goods and services that I gotta buy with the wages. And that's what the Fed chair is saying is that has to stop. That's not sustainable. So price stability, right, is their number one goal. They're gonna do whatever it takes to achieve price stability. And what is that price stability? 2% inflation. Even though they're happy with the progress, they know we're not out of the woods yet. And that's what he said. Hey, we're not taking off the table that we won't continue raising rates. We will look at the data. Right now, we're good where we're at. We wanted to pump the brakes and kind of see what the economy would do. So I think the last raise in interest rates was in what, July? Now, he also mentioned this too. He mentioned the third quarter GDP numbers, 5%. That's not good, guys. That means despite all of these rate hikes they've done, all of this tightening they've done, third quarter GDP is still above 5%. That's too robust, guys. That's too hot. And he basically said that. That's too hot. It's too hot. But again, they believe that that lag effect will catch up to companies. It's going to catch up to the American people as well. Now, let's talk about housing decline. And he specifically talked about the housing market. And one main point he stuck on, in my opinion, was interest rates. So for him, what they did with increasing the short-term interest rate, AKA the Fed funds rate. I know a lot of people say, oh, the Fed funds rate has nothing to do with the 30-year fixed rate. That's a lie, it does. Yes, it does. Indirectly, it does. Because the Fed funds rate affects what? The 10-year Treasury. And the 10-year Treasury rate affects what? The 30-year fixed rate mortgage. Why? Because the 10-year Treasury rate competes The 10-year Treasury bond competes with what? The 30-year fixed rate mortgage backed securities, right? When you bundle all these mortgages and you sell them off in the secondary market, guess who they compete with? The 10-year Treasury bond. It does. So it does affect. Normally when your secondary market Treasury bonds are trading lower, guess what? Your 30-year fixed rate mortgage rate is trading higher. That's its direct competition, right? In the secondary market. So Fed funds rate, in my opinion, indirectly affects your 30-year fixed rate mortgage rate. And the chairman basically said that's the main catalyst behind the housing market declining. Not prices. We're talking about activity. We're talking about affordability, not prices. Let's not get those two things mixed up. Prices are where they're at because we have no inventory or very little inventory. That's why prices are staying relatively high, right? And there still is a segment of buyer out there, even at that higher price, for what inventory is out there. I've already told you, you got 70 million baby boomers. You also have international investors buying real estate here in the US. They don't care about interest rates, they're paying cash. And then you got big, gigantic conglomerates like BlackRock buying up residential real estate. They don't need no loan. They're BlackRock. They pay cash. So for the limited supply we have in the right location, there still are buyers, guys. But what the Fed chair was talking about is your normal everyday American cannot afford to buy a home with interest rates at 7.5%, 8%. Can't do it. Doesn't make sense. Can't afford the monthly mortgage payment. So that's the reason why the housing market is declining. Because of affordability. People can't afford to buy houses. And if people can't afford to buy houses, national home builders ain't gonna build any. They're not gonna assume all the risks. They build, a million homes over the next 2 years, but nobody can afford to buy them. Who takes all that risk? Home builders. They're not gonna do that. They're not stupid, right? So therefore, you don't have any new inventory, not in a large quantity coming to the marketplace. Not with interest rates at 8% for a 30-year fixed rate mortgage, guys. So therefore, the rate hikes have definitely did what? Slowed down the housing market because of affordability. Not prices, but affordability. People cannot afford the monthly mortgage payment. Not at 8%, not at 7.5%. They can't. Most people can't pull that off. Plus, even if you could pull it off, the prices, right? You talking about even you can't go anywhere and find a brand new, at least I won't say anywhere. Let's say Southwest Florida where I live. You can't come to Southwest Florida in any community. I'm talking about new construction community, maybe even a resale community, but specifically new construction. You cannot come in new construction and get you a 3-2 ranch for under $400,000. You can't. You can't. Why? Again, we did have this big old gigantic pandemic that really messed up the supply chain. Guys, it's still not 100% back. The supply chain is still not where it was pre-pandemic. I'm telling you, dude. Listen, I'm telling you, you try to do anything. I'm telling you, you down here in Southwest Florida, any type of home improvements, any type of rehabs, all the material is a lot more expensive than it was pre-pandemic. It was. It still is. It's still more expensive. So my point is, builders, national home builders, do not want to assume all the risks. They're not going to bring on a lot of product if they don't have any buyers, right? I'm talking about large scale buyers. I'm not just talking about your upper 20% of the wealthiest people in this country and international buyers in BlackRock. They make up a small portion. The larger population of people that buy homes are your middle income, upper middle income Americans. All right, that's it. That's who the national home builders want to sell to. Why? Because they got cookie cutter houses. They're not custom houses. They're all cookie cutter. They're the same house. You might get a few little things inside the house that are different from the house next door, but the building itself, it looks just like the next one. That's what they do. It's scale. That's how they can scale and do all of these homes, and they can make money. They're not gonna specify one. Every one of them not gonna be custom in a community that got 1,600 homes that a national builder is building out over the next 5-10 years. They're not gonna do it. And right now, that's not happening. It's not even happening here in Southwest Florida. One of the largest home builders, Lennar. Every day I get emails from the Lennar Group here in Southwest Florida. Why they still got me on their mailing list. Before I bought my dream home, I would go to Lennar Communities because that was, a builder that I was particularly interested in some of their floor plans. I'm getting all kind of emails, guys, from them every single day. We're slashing prices. We're buying down your interest rate. We'll do all of this stuff for you. Why? Because they're sitting on all of this inventory, guys, that they built during 2021 and 2022. They still got a lot of that inventory they ain't sold. And now they're just slashing prices to get rid of it. This is Lennar I'm talking about, one of the largest home builders in America. Why do you think they're doing that? The reason they're doing it is because sales activity is down. They can either sit on all of that inventory and be stubborn and don't reduce their price, and they're gonna keep sitting on it. The only way they're gonna get that stuff sold, they're gonna have to reduce those prices. They're gonna have to give these buyers incentives. They're just gonna have to. And that's what they're doing. Now, if I'm a homeowner and I bought my property, let's say in 2019, 2020, first half of the pandemic, I went ahead and pulled the trigger anyways, and I'm sitting on a ton of equity, and I'm sitting on a 3.50 interest rate or better. Guess what I'm saying to myself? Ain't no way I'm selling right now because I don't want to trade my 3.5% fixed in for 7.5% fixed. Yeah, I got a ton of money in my property. I got a ton of equity, but I'm not willing to trade up. Why? I'm going to have to pay more for the new property. That's number one. I'm going to have to pay more than I paid for this one. So that's going to eat into some of that appreciation they've experienced. And then two, when you double your interest rate, you're going to double your loan payment, monthly loan payment. So over time, you're going to eat into the rest of the profit that you made. This is the way it is. So a lot of these smart homeowners are saying, you know something? We ain't going back to pre-pandemic prices. Yeah, I might take a haircut a little bit if I wait till 2025, 2026 to sell. I may take a haircut, but that's okay. I'd rather take a small haircut on my equity than to have to buy a home twice what I paid for this one, because that's what's gonna happen. A lot of these people gotta pay twice, at least down here in Southwest Florida. I can't speak for the rest of the country, but I know in the community that I bought in 11 years ago, before I bought this new house here, I bought in that community 11 years ago. I paid $395,000 for that house. Brand spanking new construction, ground up construction, paid $395,000. I'm gonna sell that house for $750,000, almost twice what I paid for it. And that's the going price. And my house is gonna be one of the cheaper ones because I don't have a pool on that house. Other houses in there, just like mine, same footprint, with the pool and the jacuzzi package, they're going for almost $1 million, man. And I guarantee you those people only paid $495,000, $525,000 for them. That's what you gotta run into if you are a existing homeowner looking to put your pre-pandemic house up for sale and get the windfall. You're gonna have to go out and buy something brand new or resale, and you're gonna pay twice what you paid for that other one. That's the dilemma people are in. That goes back to what the Fed chair was saying. That's also one of the reasons why you're seeing the housing market decline. Number one is interest rates. And then number two is national home builders don't want to take all the risks, so they're not mass building homes. And then number three, if I'm a homeowner, existing homeowner with a ton of equity and a low fixed interest rate, I don't want to give up my low fixed interest rate for this crazy interest rate that they got out here now. Those are the three things slowing down the housing market. Now let's talk about recession. Let's talk about recession because the Fed chair, he talked about that. One of the reporters in the audience asked him, well, in the Fed minutes, didn't see y'all say anything about recession pending or recession on the horizon or anything like that. And in a nutshell, he basically said, no, it ain't in there because we don't believe there will be a recession. That's what the Fed chair said. Now, could that change? Hey, man, he's a human being. He ain't got no crystal ball. But the reason he's saying that is because of the data he's seen. The reason he's saying that is because he sees the third quarter GDP numbers. Third quarter GDP numbers for 2023 do not suggest we're headed to a recession. Not when you have 5% growth. That's not recession data. And that's basically what the Fed chair said. That's not recession data. When you see an average of 266,000 new jobs being added to the economy over the last several months on average, that doesn't speak to a recession, guys. When you see unemployment at 3.8%, that does not point to a recession. When you see the Fed put a pause on rate hikes, that doesn't speak to a recession, in my opinion. You know, I'm just paraphrasing what I heard him say. Now, again, you guys go take a look and come up with your own conclusion. But I'm telling you, I don't see a recession on the horizon unless something breaks in the economy that we don't see, that I don't see. But right now, the Fed chair went on record and said we didn't include any of that recession stuff in our minutes of our meeting because we don't believe there will be one. Not pending, not anytime soon. Now, who knows what could happen next year? You know, we got all these war conflicts out here that America is right in the middle of. Our U.S. government is right in the middle of all of them. So we don't know. We still don't have a government funding bill signed yet. We got a temporary one in place, and that thing is going to expire November 17th. So we need to be figuring out how we going to fund the government after November 17th, which is what, a couple weeks? I don't even know. I haven't been following what's going on in the House of Representatives. Do we even have a Speaker of the House? You guys drop me some comments and let me know. I ain't even been following that. But the last time I checked, we didn't even have a Speaker of the House. So how in the world are you going to get a government funding bill passed when you're not a fully functioning House of Representatives? You can't without a Speaker of the House. So we are in some turmoil, man. But having said that, the Fed chair said, we're not raising short-term interest rates. We're going to pause. We're going to wait and see what happens. We're going to see what the economy does over this next month, right? Before their December meeting. Now, a lot of quote unquote experts don't believe there'll be any more rate hikes. They believe we're done hiking. We've reached the peak. Now, the Fed chair didn't say that. The Fed chair said, hey, we always reserve the right to rate hike again if we feel like we need to. Right now, we just felt like we've done enough. Inflation's coming down. We believe it will continue to come down. We also believe the labor market will continue to soften as interest rate hikes catch up to the labor market. We believe it's a delay. They haven't caught up to them yet, but it's coming because money is just too expensive to borrow, and we're going to keep rates higher for longer. So that tells me it's going to be very expensive to borrow for another couple of years. That's what that says to me. It says to me, we're not going to reduce the short-term interest rates, not a significant amount, for at least a couple of years, because it's going to take that long for inflation to get down under 2% and stay there. And he said, hey, we need the labor market to soften more than it has, even though it has softened when you look at today's numbers versus January, February numbers. It has softened, but not enough. One thing he said also is when you see third quarter GDP numbers at 5%, that also tells us the American people are still spending a lot of money. They're still spending. You don't have 5% GDP growth, guys, unless someone's spending money. 70% of our economy is what? Consumer spending. So that means that 5% growth in GDP for a quarter is a direct result of Americans still spending money they don't have. And we wonder why inflation is still sticky at 4% headline, not headline, but core. It's still sticky. If you want inflation to come down to 2%, you got to stop spending. Right? You got to stop spending. Not completely, but dang on it, man. 5%? I mean, that's like double what it really should be. You really want to see what? Inflation at 2%, and then you want to see GDP slightly higher than that. That's where you want to, that's really what, that's the sweet spot. The sweet spot is GDP just above inflation. Now, right now, you can say, hey, that's what we got. We got 5% GDP and 4% inflation, but that ain't sustainable. That's the problem. See, with those numbers, with those metrics, there's no price stability. Because, see, everybody in America can't afford goods and services at those metrics. More people can afford the basic things they need when inflation is at 2% and GDP is above that. Then people can afford it. People can't afford at 4%, then GDP at 5%. You can't do it. It's not sustainable. And the Fed know that. That's the reason they said we're going to keep interest rates higher for longer. All right, let's talk a little bit about the stock market. What does that mean for the stock market? Interest rates higher for longer. Well, here's the deal. If I can go out and get a 10-year treasury bond, right? 10-year treasury bond at dang near 5%. I don't know what it is today, but it's somewhere in that 5% range or close to it. But if I can get a 10-year treasury bond at 5% interest, guys, come on now. If I'm a person of wealth, I'm a person that already has my wealth. I'm not trying to build wealth. I already have my wealth. Let me run you through this scenario. I got $1 million worth of wealth. I can get a guaranteed 5% return on my $1 million. No risk, because it's what? Backed by the full power of the United States of America. And the only way I don't get my money back is the whole country got to fail, right? We got to get wiped off the map. Our dollar got to go to zero. That's the only way I don't get paid. And that ain't happening. Or do I take my $1 million and throw it in this volatile stock market that's up one day, down? If I'm already at wealth, which one you think I'm going to pick? I'm going to pick that treasury bond, man. Forget the stock market. I'm picking the treasury bond. Listen, man, I get a 5% rate of return guaranteed. I can go to sleep at night. My principal ain't going to fluctuate. I'm not going to lose my principal. Why in the heck would I keep my money in the stock market if I'm already at wealth? You wouldn't. And that's what's happening, guys. That's why the stock market is doing what it's doing. Or at least one of the reasons. People are pulling their money out of the stock market because it's too volatile. I'm not talking about your people in the building stage of wealth. I'm talking about your people in the enjoyment stage of wealth are pulling their money out and saying, forget this crap. If I can get a 5%, I'm not guaranteed I'm going to make 5% in the stock market next year with this volatility. Why in the heck would I stay in there? And that's what's happening. One of the reasons why you see all this volatility and these stocks falling in value is because people are pulling their money out, people who already have built their wealth. And they are looking at these treasury bonds, a 10-year treasury bond at 5%. Heck, man, you can go to your local bank and get a CD. You can get like a 5-year CD, man, for 5%. And a lot of people are doing that, man, of wealth. They're saying, look, if I can take $2 million and get me $100,000 in income guaranteed with no risk of my principal, I'm out of the market. Forget the stock market. I'm out of here. But what that does is it starts doing what? When people start pulling money out of companies, guys, their stock price falls. But for people in the building stage of wealth, like myself, even though I have wealth already accumulated and I'm in the enjoyment stage of wealth, I'm still building wealth. So for me, I got a lot of my money still in the market. Why? Because I'm not taking income off of that money right now. The people I just spoke about who are in the enjoyment stage of wealth, they're not actively working anymore. They're not actively earning. They live off of their investments. That's how they take care of themselves. So I have no problem with them taking their money out of the market because I do the same thing. If I'm in a position where the only way I take care of myself is my little nest egg I have, I'm gonna take my nest egg out of the stock market and put it in something I can get a guaranteed rate of return of 5% or better. And you can do that right now with a U.S. Treasury bond, a 10-year Treasury bond. You can do that at your local bank. They're giving out CDs, man, at 5% right now, certificates of deposits. Hell, you can get a high-yield money market and get over a 5% yield. Why in the hell, if I'm at wealth and I want to protect my wealth, why would I gamble in the stock market? I wouldn't. That's why interest rates, that's why short-term interest rates hurt the stock market. Because every time they raise the short-term interest rates, guess what happens? Guess what happens? U.S. Treasuries, some of them, like the 10-year, the 2-year, they go up in interest rate. When they raise those rates, they go up too. And guess what happens at your local bank? The CD rates go up. Why? Because now, with Fed funds rate at 5.5%, and banks can charge 3% higher than the Fed funds rate to consumers on loans, banks have an incentive to gather as many deposits as they can. And the only way they're going to get those deposits, they're going to promise these depositors some interest. But the bank ain't worried about it. They'll give you 3%, 5%. You know why they're not worried about that? Because they're lending that money out to some joker out there for 8%, 10%, 12%. They're taking your money. They're going to give you 2, 3, 4, 5% interest on it, and they're going to turn around and double the interest rate to somebody else. And that's how banks make money, guys, right? So short-term interest rates do affect the stock market. Why? Because people who already are at wealth, if they can get an attractive return with no risk, they leave the stock market. And that's what's happening. They're leaving the stock market in groves. Institutional investors, big old gigantic hedge funds. Guess what they're doing? They're doing the same thing, right? Now, they still are in the market, but they do take large positions out of the market and put them in short-term instruments like a T-bill, right? They'll put them in a T-bill and get a nice little interest rate on them. They'll move them and put them in something else that doesn't have the volatility, some other type of bond. And then they'll go back and shift it back into the market again when they feel like it's appropriate. But that's where that volatility comes from. You got to understand, 75% of the activity in the stock market, guys, is from institutional and gigantic hedge fund and these billionaire retail investors. 75% of the activity in the stock market is from these gigantic players, guys. Not you and me. We represent 25%. 75% of the big boys. And when them big boys move money, man, they move in billions. Billions on top of billions on top of billions. That's why the stock market fluctuates. But if you're in the building stage of wealth, that's not a bad thing. Because we want to buy these very good companies at a discount. That's why I keep telling y'all I keep buying right now. I'm not running from it because I know there's more wealth to be built. But I also have a high income skill set where I'm making money. So I'm not worried about if my nest egg fluctuates a little bit because I'm not going to use that money for another 10 or 15 years. But for people that don't have active income and they have to live on their nest egg right now, I certainly don't blame them for taking their money out of the stock market. Not if I can get a 5% 10-year treasury bond, or if I can get a 5-year CD at my local bank and they're gonna pay me 5.50%, and my principal is 100% guaranteed, and I can go to sleep at night, and yeah, I might take a little bit less income, but I'm okay with that. I'm retired. I'm debt-free. I'm chilling. Only thing I'm doing is just enjoying life. So that's what folks are doing, and that's what the Fed chair knows and alluded to. That's why you don't necessarily see them really focusing and talking about recession. Even though you would think with high inflation, right? You would think with high interest rates at some point things would slow down. It should slow down, but when you got this red hot labor market, yeah, it's tough to slow down when you got jobs, man. You got wages on those jobs. It's tough for it to slow down when you got 3.8% unemployment. That's one of the lowest rates we've had in a long time, guys. And the Fed knows that. But see, their position is that's the reason we're going to hold rates higher for longer. We believe it's going to catch up. We believe the lag effect is going to catch up. It's going to kick in here. These rates are going to kick in, and guess what? We're going to leave them up there. We're going to leave them elevated until it does kick in. So we could be stuck with these 5.50, 5%, 4.75 Fed funds rate for the next 2 to 3 years, guys. So that means the stock market will not flourish to its full potential with rates that high. It won't. I've already told you why. Because most people, even these institutional investors, they're going to pull their money out if they can go and flee to safety and get 5%. If I can go get 5% at safety and not have to worry about my principal, I may do that. I may do that, right? And that's what a lot of institutional investors, because who money is institutional investors investing? People at wealth. So if I'm at wealth, I got a couple mil, and my money with Merrill Lynch, institutional investor, my money with Merrill Lynch, I got $2 million with Merrill. I walk into my Merrill guys or gals office and say, hey, take my money out of that and put it in a 10-year U.S. Treasury. Guess what that person has to do? They got to do what you tell them to do. It's your money. So even though institutional investors and big hedge funds, for the most part, have all the movement in the market, they got 75% of the movement, especially the big hedge funds, they still have clients. They got pension funds, they got retirement funds, they got a lot of retail funds that flow through them. And when those customers come in and say, hey guys, it's getting a little too sticky for me, put me in that 10-year treasury and give me that 5% for 10 years. They got to do it. Or at least a portion of their money they can move there. So understand that's why the market is doing what it's doing and how it's tied to interest rates, guys. And again, that's my opinion. You guys make your own decision, make your own, come up with your own conclusion. Because I know I'm going to have a few knuckleheads in the comments. Oh, it's because of Biden. That's the first thing they're going to want to say. Oh, listen, man. We gotta listen, man. Worry about your wealth. Worry about building your wealth and getting yourself to freedom. Stop worrying about all this stuff you can't control, man. Stop worrying about stuff you can't control. I don't know why in this country we love to get in the middle of stuff that we got no control of. And we will go to the grave fighting for something we got no control of. Control your financial freedom. That's what you got control of. Control your financial freedom. Get to freedom. Understand what's going on right now in our financial system and in our economy. Understand what's going on in the market. And then position yourself to build wealth. I keep telling you, if you're in the building stage of wealth, what's happening in the stock market, in my opinion, is an opportunity. It's an opportunity for you to build wealth because, hey, no greater time to buy assets in volatile times, guys, because they're discounted. I said this morning in my video this morning, I said, you look at Apple, the most valuable company in the world. These guys were trading under $160. They were trading under $170 a share. How in the world do you not buy Apple if it's trading under $170 a share? How do you not at least size it up? That's what I'm telling you. How do you not buy Vanguard S&P 500 VOO when it's trading under $400 a share? Probably can continue working itself down. So if you're dollar cost averaging, you just buy down the dip. You just buy down the dip. If I got $10,000 to invest, I don't take the full $10,000 right now and just put it all in one thing. No, I take $1,000 over the next 10 trading days, or I take $500 over the next 20 trading days, and I just buy the dip down. That's how I would do it. I wouldn't take the 10K and just, roll it all on black. I would just divide it up into 10 trading days or 20 trading days and just buy the dip. That's what I would do, because history tells me, if I dollar cost average in, and I do that over a long enough period, and good blue chip assets, history tells me that I should make some money. I've done that for 25 years. So when I say history, I'm talking about my history. I'm also talking about statistical information that you can go out online and look up yourself. Go look at the S&P 500 over the last 90 years. On average, 7 to 10% rate of return. 90-year average. Give me one 10-year block of time where the stock market has performed negatively in a 10-year block. Just give me one time in the last 100 years. You ain't gonna find it. People either make their money or they hold their money in paper assets, guys. They either make their money in the stock market or they hold their money in the stock market for growth and income. I'm just telling you. Same thing with real estate. People make their money in real estate or they hold their money in real estate for what? Appreciation and income. That's what assets do. That's what they're supposed to do if you buy the right ones. My recommendation is, if you have not had a chance to go look at the Fed chair's comments today, take some time this afternoon, go out online and just put in Fed chair's comments today, and it'll come up. Click on it. It's about an hour long. But really, the most important part of it for me was like his first 10 or 15 minutes when he just gave his synopsis of where they believe the fight to bring inflation down is, as it relates to interest rates and what they're doing and what they believe is happening. That right there, that first 15, 20 minutes, man, golden. And then if you want, stick around for the Q&A, because there's some meat and potatoes in that Q&A that was good too. But that's what I do, man. I just sit there and I watch, and I try and say to myself, how does this affect me and building wealth? I don't care about nothing else. Oh, how does it affect my neighbor and him walking his dog in the mornings? I wonder if he's going to be able to walk his dog, or he's going to have to go back to work. I don't worry about all that. What I worry about is how does that affect Richard Fain wealth building plan? Because my goal is to do what? Get to that pot of gold at the end of the rainbow. I'm not going to worry about nobody else. I'm worried about getting to my financial freedom. And if we don't do that, guys, if we don't spend some time and understand what's going on in this economy, if we don't understand what's going on with rates and how it affects the stock market, how it affects real estate. And again, you ain't got to be no expert, but you got to have a little bit of working knowledge of what's going on, guys. You really do. Just a little bit of working knowledge. That's why I like to kind of give y'all these recaps, but this is based on my opinion. This ain't etched in stone. This is just my opinion from what I heard when I watched the Fed chair make his comments. This is my opinion, what I heard. It ain't fact. It's just an opinion. All I'm telling you is I hope my opinion is at least triggers something. All right, I listen to this guy. Let me go check it out myself, get my own opinion. That would be a healthy way to take a look at and understand what's really going on. And all I'm telling you is go out and do that. If you do that, I think you give yourself a chance to get yourself in a pivot situation. Maybe you pivot, maybe you don't. I don't know. I don't know what your financial freedom strategy is. But if your financial freedom strategy, if you're in the building stage of wealth, is not taking a position to buy assets when they're discounted, I'm not sure how you're going to build wealth. I mean, your strategy shouldn't be, oh, I'm going to wait until all the assets are trading at a premium again and they're skyrocket high, then I'm going to buy. You're going to be the missed it. You ain't going to build no wealth that way. You done missed it. You done missed all the wealth. The wealth is built when they're discounted, and you hold them till they trade at a premium. You know, buy low, sell high. That's it. That's what you do. Not, oh, I'm going to wait until the talking heads get on TV and the 1% get the propaganda machine going, and when the 1% tell me to buy, that's when I'm going to buy. Well, that's the wrong time to buy in most cases. Why? Because they want you to buy in because they're trying to sell. And they want you to sell when they're trying to buy. Like right now, the 1% are buying. I'm telling you they are. The 1% are buying. Why? Because they're getting these great assets at a discount. And what they'll do is they'll buy them, and they'll hold them. And some of them will hold them until the next bounce, right? Let's say the next bounce, a good bounce. Let's say a good bounce comes in February of next year, where the market goes up by 10% drastically. Some of them will sell then because they're going to make their money. And then that's when you'll jump in and try to buy. And then what'll happen is the bounce will go away and it'll go back down to, and you'll be like, oh, why did I lose on? What happened to my portfolio? I thought the talking head said buy right now. I bought. As soon as I bought, it fell. You got to stop listening to the talking heads. You got to stop listening to the propaganda machine, which is the media. The 1% control the media, guys. I keep telling y'all that. What you got to figure out is what makes sense. It makes sense if I buy a tree. Let's say I buy a tree. Do I go buy a full-grown tree? Or do I go buy some seeds, plant those seeds, water them, and then let it grow to a full-grown tree, right? Because if I go buy a full-grown tree, I'm going to pay 5, 6, 7, 8, 10 times the price if I just buy the seeds. I'm going to go buy a little packet of seeds, but I got 5 or 10 years to wait. I'm just going to go buy this little cheap packet of seeds, and I'm going to plant it in my backyard, and I'm going to grow that nice apple tree or that orange tree or that mango tree, as opposed to me going somewhere at a nursery and buying one that's already full grown and I got to pay all this money. That's what it is, guys. That's how I look at the stock market. Right? I look at the stock market just like that. I look at these companies that are discounted as seeds. Now, they discounted. They're seeds today. But if I hold them and I water them and I keep taking care of them, I keep adding to it, at some point, that seed grows into a full-grown, beautiful apple tree that is going to bear fruit for the rest of its life. I look at the stock market that way. I look at these discounted companies as seeds. I'm buying seeds right now. They ain't gonna produce no income right now. They're just seeds. But if I buy enough of them and they're good seeds, guess what? At some point, they're gonna grow into this beautiful apple tree with a bunch of apples on them, and they're gonna fruit for the rest of my life. Same thing with these companies. I buy them now, I hold them. All of a sudden, they go back up to a premium. That's the full-grown tree. Now I have a choice. I can go ahead, take the fruit, and move on about my business, or I can leave it and let it keep growing. It's up to you. But that's how I look at assets, man. My job is to buy the seeds. I don't need the full-grown tree. But see, the 1% want you to go out and buy the full-grown tree. They don't want you to buy no seeds because they want to buy all the seeds. See, they want to buy all of the seeds. And then they're going to hold them seeds and water them a little bit. They ain't going to tell you about the seed. They're going to tell you, this ain't the time to buy seeds. Stay out. They bad seeds. Don't buy these bad seeds because they buying all of them, right? And then what's going to happen is when they seeds grow to a full-blown, beautiful apple tree, then they're going to tell you, guess what? You got to go buy that full-grown apple tree. Ooh, it look good, don't it? It's the time to buy. Yep, you're going to pay a premium for it, but that's okay. That's okay. See, that's how they manipulate you. So don't allow them to do that. Don't allow them to manipulate you. Look at your strategy. Figure out what you're trying to accomplish. What is your wealth building strategy? What does it include you buying? You got to buy assets in order to build wealth. When you buy those assets, it's on you. You can be manipulated into buying them when you shouldn't be buying them, or don't be manipulated and buy them when you should be buying them. Right now is an opportunity. I'm not saying you need to buy them because I'm not your financial advisor. I'm just a guy on YouTube. But if you're asking me what my plan is over the next 2 years, as long as the Fed has interest rates elevated, I know there ain't gonna be no bull market. We're gonna have some bounces, but there ain't gonna be no full-blown bull market. Not as long as them interest rates are elevated. When they start really bringing them interest rates down and you can get the Fed funds rate under 2%, or right around 2%, maybe 2.5%, yeah, that's when we can start looking forward to that next bull market. But by that time, over the next couple of years, I'm gonna be done bought so many of these seeds, so many of these blue chip companies, that when it does go back, when it does grow into a full, beautiful apple tree, when they do go back to being very profitable and throwing off dividends and buying stock back and all that stuff, when they get profitable again, that's when it's time for me to exit. That's when I would exit and I'll win. I'll win because I bought at a discount blue chip companies and I was patient. I kept buying them. I dollar cost average down, right? I just bought the dip down. Some days they may fluctuate. See, with dollar cost average, you're gonna have some fluctuate. But see, it's been proven over time, you buy at a lower per share cost when you dollar cost average, right? And then when it's time to sell it, you make more money. Now, that's not a guarantee. I'm just telling you what history says. That's the way it works. That's the way it worked for me for my 25 years. I got stuff that I bought in 2000. I mentioned the story before, but I'll mention it one more time and then we'll wrap up. So in 2012, I started with a new bank. I left one of the big boy banks, one of the big four. I left one of the big four and I went to a regional bank in 2012. And when I got to that regional bank, they asked me if I wanted to get into the 401k program. And of course, you know me, I said, absolutely. What's the match? Oh, we're gonna match you this much if you put in this much. I said, no problem. I started putting in, you gotta understand now, it started at zero, guys. Started at zero in 2012, zero. I started putting in about 10% of my pre-tax salary every 2 weeks. And of course, you know what I put it into? Index funds, right? I put it into index funds, that particular one. But it was all growth, right? It wasn't no bonds. Oh, I'm gonna go 60 bonds for, that wasn't my thing. I wanted 100% in equities. So that's what I did. I found 2 funds. Actually, I found like 3 funds, but they were all equities, big boy equities. Because at that time, that particular administrator for that little small bank's 401k program, they didn't allow you to buy, they didn't have a quote unquote S&P 500 index fund that tracked the S&P 500 index, but they had some large cap, mid cap, small cap, international funds like that. I didn't mess with the international funds, but I put it in the large cap, the mid cap, and the small cap fund. But I put 50% in the large cap, put like 25% in the mid cap, and like 25% in the small cap. I started out at zero. And then every 2 weeks, they would auto deduct pre-tax, shoot that money in that 401k, split up between those 3 funds. I held that until 2019. So 7 years. I left the bank. I retired from banking. I quit. And I started doing YouTube videos, right? Full time. But when I got the paperwork to roll it over from that little small bank administrator to Vanguard, it was about almost 250K. Now, my contribution was around 105K, right? It was around 105K. So over that 7 years, I had gained like 145K. So I put in pre-tax contributions of 105, and it grew to 250-ish. So about 145 in gain, in capital gain. Now, of course, I didn't realize any capital gains because it was in an IRA, a 401k that I just rolled over to Vanguard. So in 7 years, I went from 0 to 250K. Then I took the 250K, rolled it over to Vanguard, and waited. Pandemic hit. I waited a couple more months. September of 2020, I took that 250K, I put it in Vanguard Information Technology, VGT. Why? Because it was trading at $317 a share. I mean, it was actually starting to climb again, and I was like, let me get my butt in here. So I jumped in. I held it for 3 years, and I made basically $100 a share profit. Now, that investment went from 250 to 350. My point is, within a 10-year period, I put in $105,000, and my investment through dollar cost averaging and being in the market instead of trying to time the market, it grew to over $350,000. So I made a $245,000 gain off of a $105,000 investment for doing what? Buying seeds, right? Buying seeds, watering those seeds, and allowing those seeds to grow into what? A full-grown, beautiful apple tree. And now, guess what that money is doing? It's 350K, just a part of my portfolio is sitting at Vanguard in a money market that's paying 5.27%, and I'm waiting on what? The next deployment, right? The goal is over the next 10 years, just that little one, and I got about 4 of these 401ks, right, because I've worked at like 4 different banks. That's just one of them. So I'm waiting on that one now to deploy again. And the goal is, because again, you can't make any contributions to it. So it just sits there until I deploy it. I'm gonna deploy it, but it's gonna be deployed here when I feel like my target price, because I'm gonna go back into VGT. Right now, VGT is trading at, I don't know, it was like a hair over $400 a share. If VGT gets back down to $300 a share or $325, something like that, I'm gonna reallocate that $350 back in. If it doesn't, I'll leave it in the money market account until I find the right investment for it. The other part of my investments are still in their funds working. My point in telling you all that is what? To back up my point about buy seeds, right? Get into the market. I don't care if you got $50 a month, $100 a month, $200 a month. I don't care what your dollar amount is, guys. This is an opportunity to multiply it. But you got to be patient. You got to buy the right investments. You got to be consistent, and you got to be disciplined. If you do that, this is a great opportunity, in my opinion, for you to build wealth. It is. I believe that. But it doesn't matter what I believe. It's what you believe. It's what you believe. But this is a great opportunity. And like I said, today, with the information I heard from the Fed chair, these next couple of years are going to be great opportunities here in the market, right? Here in the stock market, we're going to have some opportunity over these next couple of years to buy paper assets and really build some wealth if that's what we want to do. But you can't be afraid. You can't be scared. You can't be manipulated by the 1%. What you got to do is figure out what's important to you and what you're trying to get accomplished. And if you believe paper assets can help you accomplish that financial goal, then give it a shot. You guys know I got the Webull link down in the description box. So for you guys that are still hanging in here, hey, if you don't have a brokerage app that you're using, that you're comfortable with, that you're happy with, try Webull. The link is down in the description box. That's the one that I use on a day-to-day basis. That's the one I'm using for the Magnificent 7 stock portfolio build that you guys know I've been talking about. So all I'm telling you is, if you're interested in building wealth and using paper assets and you're brand new to this thing, Go down to that description box, click on that Webull link, open up the Webull account. They're gonna give you up to 12 free stocks for just trying out their brokerage app. And then what I'm gonna do is I'm gonna send you a free Webull tutorial video to walk you through how to use that Webull app. Just the basic nuts and bolts though. But you gotta send me a DM at RichardFain28 on Instagram. Richard, I opened up that Webull account like you asked me to. I put money in it. Send me the tutorial video. And then I'm gonna send that out to you. And it's gonna give you the basics to use that app to be able to buy your favorite companies and your favorite ETFs. So, Webull link down in the description box. Also, guys, do me a huge favor before I get out of here, and I'm getting ready to get out of here. I know I've been long-winded. Hit the thumbs up for me. We're a little bit light on the like button. And I understand that's how it works in these types of live streams / videos. But if you guys will do me a favor, hit that like button for me. If you appreciate the content. Again, you don't have to agree with everything I say. Again, this is not a convince you channel. It's just a opinion channel. It's not a convince you channel. So if you at least appreciate my opinion and my viewpoint and my take on what I heard the Fed chair say, Jerome Powell, give me a thumbs up. Give me a thumbs up. It helps the channel and it helps me too. And I really, 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 really would appreciate it. We want to help as many people as we can, guys, get to financial freedom. And the way we do that is by hitting that like button, and then YouTube is going to share this video with more people. So if you'll do me that huge favor, I would be greatly appreciative of it. And thank you again, guys, for stopping in, checking in, tapping in to this live stream / video. I hope you learned something, or at least I hope you got something to think about, right? Building wealth. Building wealth. I think it's a perfect time to build wealth. I think paper assets might be an opportunity for you to multiply your money and create wealth for yourself. Create a pot of gold at the end of the rainbow, right? And if you want more information on that, email me, man. I got an email address down in the description box. I got a company called RF Financial Consulting. And in that company, I do one-on-ones. I do 1 hour, one-on-one financial sessions. Guys, I'm not a financial advisor. So I'm not going to spend that 1 hour and say, okay, let's dissect every stock in the stock market. Let's look at every graph. That's not what I do. I don't know nothing about no graphs. I don't look at no graphs. All I can do is sit down with you and help you with your mindset. Help you reprogram all this crazy stuff you've been programmed with since birth about financial system. I can help you put a plan together. Now, I'm not going to write no plan down. I'm not finna type one out. I'm not finna email you one. That's your responsibility. If you want to build wealth, guess what? It's your responsibility. I'm a guy who provides information based on my 25 years of experience as an investor and my 25 years of experience as a commercial banker. I provide information. That's why it's called RF Financial Consulting. It's not RF Financial Advisor. I don't advise on stocks and all that stuff. What I tell you is hey, what do you want to get accomplished? When do you want to accomplish it? And that's how we start building the plan. It's not, how many ETFs do you currently have? How many? It's not that. Because see, that right there is the easy part. The hard part is this, is mindset. Changing and reprogramming the way you think is the hard part. The easy part is buying stocks. The easy part is buying an ETF. That's the easy part. The hard part is just reprogramming yourself out of bad money habits. Reprogramming yourself with good money habits. So if you got good money habits, you got a good behavior with money, you normally will take money and multiply it. But if you got bad behavior with money, I don't care how many courses you buy, I don't care how many one-on-one sessions you go through, I don't care how many masterminds you pay for, I don't care how many real estate seminars you go to, I don't care how many, what that dude name, the rah-rah guy, Tony Robbins. I don't care how many Tony Robbins tapes you listen to, you're not going to build wealth unless you reprogram yourself, right? You got to reprogram yourself. Because right now your program says what? Get your butt up every day, go work 10 or 15 hours, work your tail off. The money you do make, go spend it on stuff you don't need, so that way people can think you doing good. That's how we're programmed. Why? Because that's how our financial system is programmed, right? That's the only way our financial system works, is through consumer spending. So everything you look at on TV, everything you hear on the radio, everything you look on social media, that's what it's all directed to, you buying something. You got to reprogram yourself. Every time I take $1 and I buy something I don't need, that's $1 I don't have to put in my own wealth building strategy so that I can get to freedom. So that's what I do in that company. If you're interested in that, email address down in the description box. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace.